Hi, everyone. Welcome to our webinar. This is Wes Middleton with MRZ in Houston, Texas. We're a public accounting firm, and today we're going to start this webinar by talking about the Tax Cuts and Jobs Act changes and how it relates to your business. And so as we get started, if you have questions or things you want to know more about, there's a chat box on the presentation, and you can enter your questions or comments there. Probably won't get a chance to respond to them here while we're talking, just because I've got the material to get through, but we will follow up. Someone will be monitoring the chat, and as we can follow up, we will. And then if we don't get followed up, like during today's webinar, we'll follow up with you after the webinar is over. But feel free to ask questions and comment. It definitely helps us for our future presentations, and we'd love to get your feedback. So let me tell you just a little bit about me. My name is Wes Middleton, and I'm a tax partner here at MRZ LLP. I also just happen to be the managing partner of the firm. I spend a lot of my time working with small and medium businesses and the owners with their tax compliance, tax planning and strategy, and I love to work with partnerships, corporations, S-corps, you name it. It's something I really enjoy doing, and you can check us out at mrzllp.com and connect with me on Twitter at WesleyMCPA is my handle. I'd love to connect with you and share with you on there, and you can also follow me on LinkedIn. So now that you know about me and the firm, let's jump right in, and let's talk about how the tax law that was just passed here in December affects businesses. The first couple of slides that we're going to go through, I'm going to give you an overview real quick of some of the things we're going to talk about so that you know what's coming. We're going to talk about the corporate rate change, the repeal of AMT, the pass-through deduction. We're going to hit on that. We're going to talk about the repeal of Section 199, the domestic production activity deduction, and the increase to Section 179, bonus depreciation. We're going to cover the expanded accounting methods for small businesses and how that could affect you. The use of the NOL carryback, interest deduction limitation, and there's some very unique things about that you'll want to hear that some people are really not paying attention to, that it's important that you hear what those exclusions are. And then we'll talk about the overall corporate shift from a worldwide system to more of a territorial system. So why don't we dive right in, and we're gonna first talk about C corporations, and I did that first just because it probably doesn't cover a lot of our audience, but it always gets the most attention just because of the big change from the 35% rate to the flat rate of 21% for C corporations. And so that's effective for tax years that began after 12/31/17. So basically, if your tax year begins on January 1st or after, your income will be taxed at 21% if you're a C corporation, and will not be taxed at 35%. Personal service corporations will be taxed at the same rate. So this is good news if you happen to be a personal service corporation and have always had to deal with this. This is really a great new change for those rates. And then the overall corporate AMT has been repealed, and how this does affect you if you're a C corporation and you've previously paid in AMT. The good news is you're going to get that money back, and you need to check in to the details on the filing of that and how you get that money back. But if you're a C corporation or you know one, someone that owns one, and they have paid corporate AMT in the past, because you're not going to be able to use that credit going forward because there won't be any AMT, the Internal Revenue Service will be refunding those dollars in the coming years. So something else to really pay attention to is, although corporations are taxed at 21%, don't forget that the dividend that comes out when it gets paid to the shareholder is taxed at 20%. And you say, well, why is it important? Well, we get asked a lot, should I be a C corporation? And because people hear that 21% and think, wow, I'm going to pay less tax at 21%. But what really is happening is is if you happen to be the owner of both the corporation and you get your income 100% from that corporation, remember that it ends up being taxed at the higher rates by paying 21% from the corporation, and then it's taxed again when you take it out as a dividend at 20%. So your effective rate ends up being 41% when you take it out individually, as opposed to the top rate right now, and under the new law for individuals, will be 37%. So it may not be a great idea to jump into that C corporation type of structure, although there are certainly reasons why you would want to do it, and ways that it could pay off for you. But that's definitely something you want to take a deeper dive into with a tax professional and make sure you understand all the ramifications for being a C corporation. But I thought I'd hit that early just because it seems to get the most press out there and talked about a lot. So those are the changes in the corporate rates. So let's take a deeper dive into some of the other subjects that we have on the list today. And the first one that we're going to take a little deeper dive into is we have this neat little thing called ASC 740. And so if you are a C corporation today, and you have to prepare financial statements, you know exactly what I'm talking about, and we refer to this as deferred taxes, but it falls under FASB ASC 740, and this is how we calculate the effect of deferred tax liabilities and assets based on what your timing differences are in your corporation. So if you're doing those today, and if you happen to be the one doing them yourself, and that you're the one calculating this deferred tax asset or liability, this new tax rate is going to have a big impact on how you report your deferred taxes on your financial statements in this year. So be sure you take that into consideration as you're preparing those deferred tax calculations, the effect of the corporate change. The next subject, next area we want to cover is a great thing for business owners. The 20% deduction for qualified business income, or we refer to it as QBI, of pass-through entities, and this is getting a lot of attention because it effectively takes the top rate of 37%, and if maximized completely, you can have your personal rate on that flow-through business to just under 30%, which is an incredible rate given what it's been taxed at over the last several years. So let's take a deep dive into exactly what that is, and let's first talk about what a pass-through entity is. And so these are limited liability companies that are taxed as partnerships, or maybe taxed as S-corps. This could be disregarded entities. It even applies to trust. It applies to your Schedule E, to your Schedule C. So any sort of situation where the income from the entity flows through to your personal return and you pay a personal income tax as a result of that income, this new deduction allows a 20% deduction of that flow-through income against your taxable income. Now, there is a lot of things that we don't know about this flow-through, and we're going to talk a little bit about that, about some of the things that could jump out to bite you on this if you're not careful. Let's first talk about those that have. So if you're married and you file a joint return and your taxable income is less than $315,000, here's the good news. None of the exclusions that we're going to talk about apply to you. And so you get this deduction without any other thought to what type of business you're in, or what the wages are of the company, or any of the things that we're about to talk about. If your income, married filing jointly, is $315,000, and it's half of that if you're single, but if $315,000, if your taxable income, not your HEI, your taxable income is less than $315,000, none of these rules apply. That being said, if you are at $315,000 and up to $415,000, all the things we're going to talk about are phased in for you. I'm not gonna spend a lot of time talking about that phase in. Just know that if you fall between $315,000 and $415,000, there is going to be a phase in of these things that we're going to talk about. But once you hit $415,000 of taxable income, these limitations and these calculations that we're going to spend some time on today will affect what sort of benefit you get from this new flow-through deduction. So let's talk about the limitations here. And so first of all, the limitation is that it's limited to 100% of the taxpayer's combined qualified business income. Now, reason I say that is because it's the qualified business income. So the things like the investment income that may flow through to you, or some of these other things that are not business income, won't be eligible for this pass-through deduction. And what happens when you get over $415,000? We have to make a calculation, and that calculation is it's complicated, but it's one of two things. So it's either A, we either go by 50% of the W-2 wages that are paid in this trade or business. That's one. You calculate that number. Or two, we calculate 25% of the wages plus 2.5% of all the depreciable property you've placed in service or that you have as of the end of the year. Your cost basis in that, not your adjusted basis. And then we'll take those two numbers, and the greater of those two numbers compared to the deduction is what you'll get. And so you could be limited to if your flow-through deduction, if your calculated deduction is higher than this limitation, you will only get the limitation, the higher of these two limitations. If your flow-through deduction is less than this calculation, you will get the flow-through deduction amount. So it's first the greater of the calculation 1 and 2, then you compare it to the deduction, and it's the lower of those two numbers. So there again gets a little complicated, but we're going to step through that and give you some numbers to look at here on the next slide. So in this slide, we took an example and said, well, if I have $1.5 million of flow-through income, and my wages that were paid out of here were only $81,971, but I have $15 million of real estate, for example, what do I get? So we do all the tests that we just talked about. So the first one we did was, what is 50% of wages? And you see that number. And then you say, well, what is 2.5% of capital plus 25% of wages? And we've calculated that number. So you first take the higher of those two numbers. So we drop that down into the next box. And then we go to the next box and we say, well, from that first calculation as compared to the 20% deduction, what is the lower of those two? And the lower of those two is the $300,000 deduction, and so that is what you'll be able to take. So, for example, let's say maybe that capital was lower, and that number only came to $195,000. What we know then is that if the lower of the 195 or the 300 shows up, then you're going to be limited to that lower calculation on the capital and wage test. So it's important to know today. If you wait until December and try to figure out what are my wages, what is my capital, and you don't know this going in, you could find yourself missing out on this deduction. Had you taken a little higher wage or done some things differently in your business, you definitely could benefit from some planning in advance. So here's the interesting part about this calculation. And if you go to our website, mrzllp.com, and you go to the ideas page, there's a blog that we have. So I posted this in the blog because, and it'll take a little deeper dive in the blog than I will today, but in the original bill that was passed by the House of Representatives, what they proposed was the total business income, not just the flow-through amount, and it included the wages. Because if you think about it, if you're a Schedule C, what are your wages? Well, you don't have any. And as long as you make less than $315,000, you don't have anything to worry about. But what if you have $600,000 under Schedule C, but you have no wages? What happens then? What is your wage test? Because you have no wages, do you not get the deduction? Well, that's one of the things that, as the law was written today, and if Treasury had to interpret it as it's written today, in the strictest sense of the way it's written, you would not receive a deduction. That being said, if you go back to the way the House proposed it, and you believe that maybe that was the intent and a correction may be coming, the House was clear that those things that are subject to self-employment tax, such as the flow-through from the Schedule C or the guaranteed payments from a partnership, they would be treated the same as income from the business, not with any limitation like is on the W-2, or they'd be counting as W-2, be the same type of thing. So the same thing if you're a partnership. If you think about real estate partnerships, partners don't take W-2 salary. They take guaranteed payments for services. And so although the character of the W-2 and the character of the guaranteed payments are technically both the same in that they're both subject to employment taxes, in a very strict interpretation of the law today, those guaranteed payments would not count for you in this calculation. So you can see how difficult it would be to really take full advantage of this calculation if you make more than the $415,000 and you were a partnership and you didn't have enough guaranteed payments or enough wages. You didn't have enough wages and your guaranteed payments didn't count. You could be severely limited on taking this deduction, and it would actually be inequitable between the various types of entities. Again, for example, an S corp. Well, an S corp owner is required to take a salary out of that S corp, and so it's just natural that an S corporation owner would have a W-2 wage by which to make this calculation and make this measurement by. But a partnership A wouldn't have those W-2 wages to the owner, and two, a Schedule C would not have W-2 wages to an owner. So you can see there's a little bit of a discrepancy in the way the law was passed and then the way the House intended for it to be passed when they proposed this change, if you look into it. So there's a little deeper dive on our blog if you want to check that out. We talk about that a little more, wrote about that. So let's move on to the entertainment and meal deductions. And this is something that's really gonna be a big change because they repealed the business entertainment expenses. And so this gets a lot of discussion out there because I think it's very common that in the past, we've always said that, hey, you know what, when you go to lunch, make sure you talk about business, right? And that made it a business meal. Well, come to find out, that's actually not completely true, and that if you read the definition of entertainment in the tax code, the definition of entertainment specifically talks about meals with clients and prospects. And so by definition, entertainment is a meal with a client or a prospect. And so whether or not that was intended to be the case in the law, by repealing that section, it made it very clear, at least the way it's written today, that if you previously had meals with clients or prospects and you were able to deduct them 50%, well, there's a new law change, and that you're going to get no deduction for that, even if you were talking about business. And you say, "Wow, that's pretty tough," and it is. It's a significant change. Now, meals that are truly business in the respect that you need them to carry on your business. For example, if I'm traveling on business, and because I'm on travel, I have to eat for business. That is more of a business-related deduction. So you would still get to deduct those. A big change too is I know here at the firm during tax season we like to bring food in for our people because we require them to work long hours, and so that condition of employment is, hey, during tax season you're going to be here a lot of hours, and we're going to feed you because of that. In the past, that deduction has been 100% deductible to our firm to provide that benefit. Under the new tax law, that particular benefit will go from 100% to 50% and will no longer be 100% deductible. That being said, the one thing they did leave intact was more of the social meals. So when you're looking at meals for, say, the Christmas party, the food and beverages related to the Christmas party, you will still receive 100% deduction for that. So it's going to be important that going forward, you're really going to have three categories for meals and entertainment, for meals, not entertainment, but for meals, that you're going to have to track in your financial statements and make sure that when you prepare your returns, you know what these numbers are. The first being meals with clients and prospects that would be entertainment really considered meals and will be non-deductible. Meals that are now 50% deductible that were previously 100% deductible. And then the meals or the food related to the social events for your employees, such as Christmas parties, things of that such, that still meet the qualification for 100%. So really got to pay attention to that meals and entertainment deduction. And there again, I'm going to point you back to our blog, because it was an interesting read that I had from a journalist that published an article that said something to the effect that potentially the corporate expenditures for entertainment, such as the baseball games or football games and all of these dollars that are being spent at a corporate level, would potentially go away because of this rule change. And so there again, I took a little different stance in that I'm not sure that that's going to happen, because you got to remember, while you're still losing that deduction, because of the change in the rate has come down so low, it may be just as beneficial for you for having those, because if you're using those meals and entertainment to actually build your business, you may have a different reason for it, and you may have liked getting that tax deduction for it, was a little benefit of having those meals. I'm not sure that losing the tax deduction, now that you have a lower rate, it may allow you to actually spend more money on entertainment, and if it's something that drives your business. So I think the business aspect of meals and entertainment, the purpose won't change. There's no question that those that are using this benefit are going to be held more accountable for these expenditures. But it's something that's changing in the law that we all have to be aware of, because it's not just the fact that it's a business meal; it's a fact that a meal with a client or prospect is considered entertainment by definition, unless somehow that changes in one of the corrections that may be coming up. So a few other things to note there on this employee benefit was there's some changes in the qualified transportation fringe benefits. For example, we used to be able to offer a commuting benefit that was a great benefit to employees, especially here in Houston, where we have a lot of tolls and things like that. So today, we've lost that benefit, that ability to deduct that benefit, and so that's going to change some things. And then in the past, where if someone moved as a condition of employment to a new city and took a job, if you remember, there was a moving deduction, and so that's no longer going to be available to you. Something else to point out here while we're on this slide, because I think it'd be a good time, is that if you happen to be an employee, and maybe you're a salesman or you're doing something for a company that reimburses you for your expenses, okay? So that's normal. You fill out your expense report, you get reimbursed. But then there's also things that you may do as an employee that you do not get reimbursed for. You know, maybe you spent a little more on the trip than was allowed, or the meal was more than you're reimbursed for. And so over the course of a year, you accumulate some number of expenses that are related to the client development or whatever job you're doing. And then what you would normally do is on your Schedule A or 1040, you would deduct these as unreimbursed business expenses, things you did to produce the income that you're doing, but yet because you're an employee, you aren't reimbursed for them, but you get to deduct them on your Schedule A. Here's something to note today. That deduction on your Schedule A is gone. That's right. So if you spend unreimbursed business expenses thinking that you're going to get a tax deduction for it in 2018, take note today that you will not get that deduction on your return. So it might be a great time to go back to your employer or go back to whoever's paying you that, and it would be better for them to actually lower your salary and pay those expenses potentially than it would be for you to go unreimbursed in those meals or whatever it is you're doing that you think maybe you're at least going to get the tax benefit from, because that is not going to be the case starting with a 2018 tax year. Okay, so we'll move on now to talk about depreciation, and so we've got a lot of good changes here in the depreciation laws, and so this is this first slide that we're going to talk about is leasehold improvements, and this is a little complex at first. So what I wanted to do was just give you an overview here of what the old law looked like. So in the old law, we had four very distinct areas that we deducted leasehold or real property improvements, let's call it. Let's not call them leasehold. Let's call them real property improvements. We first had the qualified leasehold, which they had to be subject to a lease, and then there was a 3-year in-service requirement of the building, okay? And then we had the category called qualified retail improvements. You had the 3-year building and service requirement. And then we had the qualified restaurant property, which is very obvious about a restaurant. And then we had qualified improvement property, which this was improvements made to real property that where there was no lease requirement and there was no 3-year requirement, but it had a longer life and it was subject to bonus. So the first 3 properties categories, you got 15-year life because of the classification. And in the last one, you didn't get that. You got the longer life associated with the type of property it was, but you got to use the bonus. Now, moving to the next slide, here's the change. The law created one classification. It eliminated qualified leasehold, qualified retail, and qualified restaurant, and it classified all of this into one package called qualified improvement property. And the intent here was to give this classification of property the same life of the old property classifications. So in the old classifications, it was 15-year life, but the qualified improvement property in the old classification was the 39-year life. Well, the intent was, hey, let's put it all into one property. Let's make it all subject to bonus. Let's take away all these different categories and different things we were doing, but let's lower it from 39.6 years to 15-year life in this new property. So while they did create the one property and they did eliminate the other 3, here's what they didn't do. They left out the change to 39.6 to 15. So wow, is that just a technical correction that's going to be coming? We hope that it is, if it doesn't fight too long. But in the interim, you got to wonder, well, am I going to get the 39 or the 15 treatment, and how does that work? And so today, the way it's going to work until it's changed is the strict interpretation is, even though they intended to change it from 39.6 to 15, one of the little technical corrections that should be coming would be to actually make that change because it was left out of the original bill. So new classification that's 15 years eliminates the other 3. So let's move to bonus depreciation and talk about that just for a few minutes. I'm sure everyone's heard about this. It's been pretty popular, is that we increased bonus depreciation to 100%, which is just great. And then it phases down after 2022 into about 20-point increments, 80, 60, 40, 20, and then 0 for 2023 through 2027. 2 big things that were great about the law is, one, they made it retroactive, right? So now, if you happen to have purchased something 9/27/17 placed in service or after, it qualifies for this treatment. And in the old law, bonus had to come from property that you were the first person to place in service, or it had to be new, and it couldn't be previously placed in service property. That changed, and now the bonus applies to both new and used, which is an incredible benefit in this coming tax year for any purchases that qualify to be able to take that 100% bonus depreciation. Now, you're still able to elect out. If for some reason you don't want to take that bonus, and there are reasons to not take bonus, you will be able to elect out. Section 179 deduction increased, and so it's a $1 million deduction for 179, and the threshold for purchases is $2.5 million. The Section 179 limitation for SUVs, it remained at $25,000. What they did do was they expanded the Section 179 to certain real property component changes, such as roofs, the HVAC or the ventilation system, the security system, and the fire protection systems. All these systems that were previously excluded from 179 have now been added to be included in Section 179. And in the past, while you couldn't Section 179 personal property related to residential rental property, that's also been removed. So if you have residential rental property and you buy items that are of a person that are personal property and you want to write them off 100% under Section 179, you're able to do that. And all of this new classification that we talked about on the previous slide of the qualified improvement property, all of that property now qualifies for Section 179. So a lot of good changes there with 179 that came into play. Depreciation on autos changed. Section 280F is the code section, and it was amended to increase the annual depreciation on passenger autos. Now these are the 4-door cars we drive, 2-door cars, the automobiles, passenger automobiles. If you remember, in the old law, there was a very significant limitation. No matter what you paid for the vehicle, you had a limitation on what you could deduct every year. The good news is that's changed. And you can see here I've put in the deductions available. So it doesn't matter if you paid $50,000, $60,000, $70,000 for the vehicle. It doesn't matter what the actual purchase amount is. You're limited to $10,000 deduction in the first year, $16,000 year 2, $9,600 in year 3, and then you're able to deduct $5,760 per year until you recovered the cost basis. Now, this is one of those situations we talked about where you might not want to take bonus depreciation. So keep this in mind. So even though you are allowed an additional deduction for bonus in year 1, okay? So you go buy the vehicle and you go, wow, what I'd like to do is take the $10K plus the additional bonus that I get to take of $8,000. I'd like to take that in the first year because it helps me. Here's the gotcha. Because you aren't able to take 100% bonus on a passenger vehicle, the actual bonus rules state that year 2 and 3 of depreciation are 0. That's right. So even though you got an extra $8,000 in year 1, you lose any deduction in year 2 and 3 because of the bonus rules. So unfortunately, this isn't one of those gotchas where there was a mistake and we're waiting on some technical correction. It's actually been this way, and the IRS has acknowledged it exists and has basically said, yes, it exists, and that's the way we're going to enforce the law. So be real careful if you're thinking about using any of these depreciation rules to buy a passenger auto, and you believe that you're going to be able to increase it in the first year. First of all, you're not going to get 100% because you're limited, and if you take the little extra that you do get, you're going to lose any deduction in years 2 and 3 because of the rules. So keep that in mind as you look at the passenger auto depreciation. Okay, depreciation is one of those technically draining issues that just will wipe you out. So let's all take a deep breath, and we're going to talk about something that's a little better, a little easier to talk about, and that's cash. And that's the cash method of accounting that's been expanded in the new law, which is a great change for many, many taxpayers. So in the new law, this law has been expanded for small taxpayers, and you say, well, what does that mean? Well, that's for the gross receipts test. And so if you look back over your last 3 years and your average gross receipts is less than $25 million, then you can now take advantage of cash accounting. And so that's going to now include many, many, many more businesses than in the past were limited about being able to take this type of accounting method. And so especially, we talked about this, and we have again, I'm going to refer you back to a blog because it takes a deeper dive into this, is if you happen to be a construction contractor, right, and you were forced maybe to use percentage of completion for your long-term contracts, and you hit that $10 million mark, well, 2 great things happened. One is the ability to use the completed contract method also was expanded to $25 million of gross receipts test, and that's just the accounting for your long-term contracts. Your overall accounting method can be on the cash basis now. So if you're a construction contractor and you're listening to this and you don't like the percentage completion cost-to-cost allocations, and you meet the gross receipts test, then you're in great shape here, and you really have a planning opportunity for the 2018 year to make some changes. So accounting methods, if you're using 263A for your inventory, that's changed, and the inventory tracking requirements has changed. So if you're in any of these types of businesses where any of these words that we're using, 263A, inventory, cash method, you're on the accrual, you're going to be on cash, it's a new day. And it's now being expanded, and so the definition of what a small business, small taxpayer, has been extended to 25 million and is no longer applicable at the lower level. So keep that in mind, and take a look at that and see if that can help you in some way. 1031 exchanges have changed, and so that's something where, where in the past, where if you had a property and you exchanged it for like-kind property, and rather than selling it, that you defer the gain on that property by exchanging it with a like-kind. So the 1031 rules did change, although they were severely modified because they limited, and this is what's interesting, is they didn't exclude anything. They just said, well, it only applies to real property. And you say, well, why is that important? Well, why that's important is although we think about how we've exchanged autos and other things that are considered personal property, it actually applies to some other areas of exchange that maybe you didn't think of. And so there's a real interesting situation with sports contracts. And, every time there's a trade of players, there's usually the contract isn't rewritten. So, for example, the Washington Redskins just traded for a quarterback, and so when they brought the quarterback in, they exchanged his contract for the contract of another player plus a pick in the future. So the IRS has taken the position that even in the past, this isn't new, it's always been this way, that those trades were a like-kind exchange, and so there was could have been a gain or loss on that transaction, except because of Section 1031, these types of things were deferred. So that's going to change. That's definitely going to create some interesting scenarios in the sports world to watch as they trade contracts. And what that leads to, though, is if you think it's just personal property that's excluded, you've now got to think in terms of things of anything that's not real property that you're excluding or you're trying to exchange, including contracts, could be subject to a gain or loss. And you have to be really careful of this as you're structuring transactions going forward. So if you want to read more about that contract exchange, there again, I'm going to refer you back to the blog site because we've got a great article on that, and take a look at that. It's just an interesting subject to listen to or to read about. Carried interest is a term you hear used a lot. Now, let's not get that term, think that it's just that term that can be used. I've heard the term promote and carry, and there's a lot of interchangeable words that could be used for what is essentially a carried interest. So what a carried interest really is when someone comes into a partnership and they are rewarded for their efforts and maybe putting the deal together or the management or whatever it may be by participation in the profits of or the results of that organization. That's what we call a carry or a promote or a profits interest or something of that sort. So that rule has changed fairly significantly, okay? And it's important to remember that when these types of things are done, more especially probably in real estate is where it happens a lot, that you may invest in something, but if you're the person putting the deal together, you get what's called a promote or carry, in that you may participate in 10% of the deal once the property is sold, and under the current rules, your participation, you would pay taxes on that long-term capital gain, and it would pass through to you, and it wouldn't be compensation to you. You would just participate, right? And so you do it because, wow, I get the same treatment as everybody else does. Well, that law has now changed. And so if you are in a situation where you are receiving a promote or carry in a deal and you sell that property, the 1-year holding rule does not apply to you. There's a 3-year holding rule for you to get long-term capital gains treatment. So you got to remember that. And there's no grandfathering in. There's no, well, we did the deal, in December. as the law is written today, there is no situation where you grandfather in. It's if the transaction happens on 1/1/18 or after, you have to look back and look at the holding period. And why this is important is because I know there were a lot of deals entered into, for example, in December, but you didn't close until January or after. And so as a result, you actually didn't know about it, but you're going to be subject to this law, even though you may have had a deal in place but didn't close on it until 2018. There was some talk there about using an S corp to hold these interests because it did exclude this rule from corporations. The IRS has come out and said and clarified that S corporations do not meet that standard for a C corporation or for a corporation, and that if you thought maybe you were going to get around this by putting your interest in an S corporation, the IRS has closed that loophole. That is not something that you're going to be able to do. So if you read about that, make sure you know that the current law has been clarified by the IRS that the S corporation will not allow you to escape this treatment. So if you got that carry, you got that promote, whatever term you may use, if you're getting rewarded with participation because of your services or your effort or your management or whatever that may be, you got to remember that holding period has changed from 1 year to 3 years. Our next section we're going to take a dive into is the interest expense limitation, and this is an interesting area that really affects us in a very unique way that sometimes gets missed, and that is while this law this limitation it limits the interest deduction to 30% of the adjusted taxable income. You go, wow, what is adjusted taxable income? So if you have to think about that in terms of EBITDA, and that is exactly what it is for this year, is all that does change, but for now, where it's at today is you would add back the interest, taxes, depreciation, and amortization, and that would be your adjusted taxable income, and then 30% of that number would be your limitation. So that's real quick what the limitation is in reference to. Now, remember this. Real property owners can elect out of this limitation. Okay. Now, if you do elect out of it as a real estate partnership, for example, there are some changes. You're not able to use accelerated or bonus depreciation. You must use the alternative depreciation method. And so there's some limitations there that if you make this election to elect out, there's some downside to that. But the good thing is you can keep taking your interest deduction. Now, the other thing is that this doesn't apply to the $25 million gross receipts test. So the same gross receipts test that got you qualified for example, this cash method of accounting and the completed contract method, it's also the same limitation that's going to allow you to escape this interest deduction limitation. Now, here's the gotcha on this, because this is something that I think people are going to stop at the $25 million and go, oh, I'm less than $25 million, so I don't have to worry about it. Well, that's where it becomes a problem, because the other exclusion from this this interest limitation is if you're a tax shelter. You go, well, I'm not a tax shelter, but oops, got to stop again and talk about just for this specific law, the definition of a tax shelter has changed. And what it really boils down to is if you have an entity that is a partner in your partnership that you allocate more than 30% of the losses to, which is, there's pretty much every real estate partnership out there that I know about, you are considered a tax shelter just by definition of this exclusion. You say, well, what does that mean? Well, that means if you're a real estate partnership and 30% or more of your partners are in this list of types of entities, in terms of the allocations you give them in terms of 30% of losses, then no matter what your revenue is, you are going to be forced to elect out if you don't want to be limited. So it's going to be real interesting for structures of entities and how things are done, especially with real estate partnerships who really use the debt to leverage up the property, and that's just the nature of these partnerships, in that you're not going to meet the gross receipts test because of you think, well, I'm less than $25 million, so I'm okay, but you're going to fail the tax shelter test, which means you will be limited, and if you don't want to be limited, then you'll either have to elect out or be limited. Now, it's not lost. You don't lose the deduction. It carries forward. You can use it. It flows through to the partners who can use it at a future date. But it is limited in that current tax year. So be real careful in this interest limitation to note that that this is a big change. So in the next slide, real quick, we're going to talk about the changes to the depreciable lives for real property if you make this election. And so if you opt out, you're a real estate partnership, you elect out, what happens? You won't be able to take bonus, and then you'll see the recovery periods that we've got on the slides that change. So 40, 30, and 20 will be the lives that you'll have to use for the depreciation of your assets. And so make sure you are familiar with those laws and those changes before you make the election to elect out, knowing what the other side of that is. And that'll cover it for the interest expense limitation. Just pay real close attention to the type of entity you are and how that affects you. So another change was technical terminations. So if you're familiar with partnerships, and you know that if there's a sale or exchange of 50% or more of a partnership interest in a year, that this is a technical termination. And I'll just say here on this slide to get through this is that there are no more technical terminations. Those are positives and negatives about that, but just know that if you're in a partnership and you're used to this and you're thinking that you're going to use a technical termination to maybe reset some tax elections or things that we use them for in a very positive manner, that's not going to be available to you from a planning perspective going forward. Contributions from a government entity or civic groups has changed, and you go, well, what does that mean? Well, you know, in our current economy, what you see a lot of is a lot of the big box retailers are leaving, they're closing, the malls, the whatever it may be, just the disruption from technology and the online services. We see a lot of real estate popping up available, and what a lot of municipalities are doing is they're coming to a developer and saying, hey, we will give you this property if you will develop it, and here's all these things we'll do for you. So in the past, because of that arrangement, if a city or municipality or civic organization did that, the developer paid no tax on that. It was not a taxable event. It became considered a capital contribution. And so maybe in an industrial park where they gave you the property to build on in exchange for you building there and being there and employing so many people, etc. So what's going to happen today is this. If you're a developer and you receive property in the same manner, it is now a taxable transaction, and you're going to pay tax at the fair market value of that property that was given to you. So keep that in mind if you're a developer and you're thinking about that and you're negotiating that nothing is free. And now when it's given to you, you're going to pay tax on it. REITs retain C-Corp benefits. And so we talked a little bit about that early on about the real estate side of things and how those changes. And so even though there's a lot of changes in the corporate rates and all those things, the REITs retain most of the C-Corp benefits that they've always had, and that didn't change. And so that's just a good thing to know that they weren't affected by that. The net operating loss provisions changed, and so any NOL that's created in 1/118 or after will no longer be carried back. You can only carry them forward, but they're carried forward indefinitely. The old NOLs that were created prior to this date are still treated the same way. They still carry forward and expire as they originally did. And then going forward, what also happens is for these NOLs created in 2018 or after, they can only be used to offset 80% of the income. So it's going to get real complicated. If you have an NOL, you're going to have the pre-Jobs Act NOLs and the post-Jobs Act NOLs, and they're going to be both treated differently on the carry-forward provision, and they're going to be treated differently in the way they can be utilized by the corporation. So although the AMT was repealed, what's going to happen here is corporations could lose money, have an NOL, have income the next year of the same amount, but still pay tax because they can only offset 80% of their taxable income with that previous NOL that was created on 1/1/18 or after. So keep that in mind as you're trying to utilize NOL. So some real quick changes here to wrap up with. There's some new changes with some limits on executive compensation. So there again, if you're a C corporation, publicly traded company, you've got some income limitations that are hard and fast now. The changes with the Section 1031, keep those things in mind. The carried interest rule, and so the expenses we talked about for the employer operating eating facilities is now not only 100%, it's 50%. So those meals we provide are at 50%. Lobbying costs are no longer deductible, but there's a new credit now for family and medical leave. So a lot of changes happening to businesses, a lot of opportunity for some planning, and so a lot of opportunity to save some tax money. But if you don't plan correctly, and if you don't anticipate, and you don't start now, and start looking ahead to how this year is going to end, and plan in advance, it could catch you by surprise. So now is the time to plan. Now is the time to talk. Not in December, and definitely not next January. The time is now. It's time to take a look at your business structure. Am I in the right type of business? My business strategy. But this 20% flow-through deduction, and it may matter how you're structured. For example, if you're a doctor and you have, and maybe because of that you're excluded from this because of the service requirement. Well, you may have part of your business that sells something rather than just medical services, and so then we can then look at that and find a way to separate that business in some way. So let's look ahead with operations of your business, whatever it may be. There's a lot of great ways to plan for this, to take full advantage if you plan ahead. Planning is the key. So I hope you've enjoyed this presentation today. A couple things to wrap up is there's a free download on our website. You can see that there on the screen now. Or if you want an ebook about this, we've got a free download for you where you can go get that and download it. And then maybe you just want some help and you need some expert consultation. What you can do is right now in the comment box you see, if you just type in the word consultation, we will follow up with you and schedule a time to get with you and talk about how we can take a deeper dive into your situation and help you plan out how these tax changes can actually help your business. So if there's a way we can help you and you're looking for some really personal one-on-one advice for your situation, just type that word consultation in the chat box, and someone from our team will follow up with you. Hey, and as one more item, I was just told that there are some more resources for you down in the handout section there that's visible to you there on the screen. You can see it. So there's some things there for you to download right now if you'd like to have some of those resources. Just click on those, and it should be self-explanatory from there. On our last slide here, just want to tell you just a little bit about our firm. And so while we are an accounting firm, we do much more than that. And so while you see all the things that we do, we also do financial planning for our clients. And so if you're looking for some financial advice at a fiduciary level where we're accountable to you for the decisions that we make and the advice that we give you, Emergency Financial is available to help you with that. We also have a valuation team that does business valuations. We do it for estate and gift, litigation support. We even can help you sell your business. And so all of those things that are additional things that we offer here at the firm, along with our consulting practice, to really help you grow your business and succeed. So thank you for joining us today, and we hope to hear from you in the comments. Please tell someone about this, share this with someone, and we hope to hear from you soon. Thanks, guys.